Okay. Good evening, everyone. On behalf of Women and Young Member Excellence Committee of ICI, it's my privilege to extend warm welcome to all of you to this Sky High series. This Wednesday program series has been very thoughtfully designed to nurture the growth and development of our cherished women and young members. It is not just about technical updates. Also, it is a platform to cultivate non-technical skills. And the aim is to empower and inspire our members to step forward and make the most of their abilities. So our members can confidently express themselves in a public forums. I recognize the presence today's speaker, Archana Bhutani, and coordinator Wrinkle Gorwara and Chandni Tulani. So without wasting much time, I'll directly introduce Archana Bhutani. She's speaker and a true authority in this field, who is a partner with a CA firm, Deloitte India, having experienced nearly 24 years of vast experience relating to technical advice on corporate law, accounting, auditing, and other related matters. She has been a special invitee to NACAS, has been a special invitee to and co-opted member of various committee of the ICI, such as the Accounting Standard Board, India's IFRS Implementation Committee, Expert Advisory Committee, Auditing and Assurance Standards Board, and etc. Archana has an extensive representation in external workshop. She has also contributed as a specialist editor to the 18th edition of Ramaya. So really, thank you so much, Archana madam, for accepting the invitation and being with us today. So before handing over to Archana madam, I just would like to share with all of you that Women and Young Member Excellence Committee of ICI is organizing 2 days residential meet of aspiring women independent director on this month end itself, 29th and 30th November at Bhopal. So idea behind it to empower and encourage women members to pursue career as an independent director. So those women members who want to become an independent director, they can foster their professional growth and enriching their skill set through this targeted technical trainings. So I urge women members who join today is to please register for the same and take benefit out of it. So with this brief introduction, I hand over Archana for further session.
Thank you so much, and a very warm welcome to all the participants. First of all, let me start by saying that when she read out this thing, and I was feeling so old, this many years, and this is a young member committee, right? So I still consider myself young. Okay. So happy to be here to join you all and happy to share my experience. I know we just have 1 hour as far as my slot is concerned, but if it's okay, I'd like to not have a rigid, the intention is to make it interactive, and I know we're online, so there are some limitations. One is I can just take you through some points, technical points, and share my perspectives on reporting. But if there are members who would like to, you can switch on your video, that would be great. If you don't want to switch on your video, that's fine. Half of the time you and I don't do it. But if you would like to ask questions, we can make it more like a Q&A so that I'm able to address the actual challenges that you're facing. And I realize many of you maybe, that's at least my perception from some of the interaction over the last few years. Many of you may be more into tax. I've seen less and less people doing really accounting and spending more time on reporting matters. But if you are, rather than me going by my agenda, I'll be happy to answer issues where you feel you get stuck. So feel free. You can just, I'm presuming, Shweta, that they can ask questions, right? They'll be able to unmute and ask.
No, they'll not be able to unmute.
If you're not able to unmute, at least just post the question. I would rather, frankly, address issues that you have but till the time you're thinking about it and posting, let me just quickly take you through some of the key points. Now, reporting standards, when we talk about reporting standards, there are a set of standards which deal with it. So you've got SS700, which talks about the structure of audit report in general, in terms of what the structure has to be. Then you've got 705, which deals with modified report. You've got 701, which deals with key audit matters. You've got 706, which deals with emphasis of matter and other matter paragraph. Then apart from this, you've also got a few other standards, like you've got a standard on comparative, etc. People tend to generally neglect those, but those are also very important. Your opening balances, because they also impact the, let's say if there is a continuing modification, how it'll impact your current year reporting. So opening balances, comparative, these are also auditing standards, which I believe are very important, not just for the purpose of auditing itself, but also in terms of the impact on your reporting. And of course, I don't want to forget SS720. I somehow feel that this is one standard which people just, for some reason, just ignore. It's really neglected. It's not getting the focus it should. Now, there's a host. And frankly, obviously, in 1 hour, I can't cover all. But some of the thoughts which I wanted to share with you here, in terms of, and why do I believe reporting standards, is important? That's because whatever work you may do, you may be spending X number of hours on an audit, but ultimately your deliverable is your audit report. Your audit report is what will speak. Unlike an advisory firm, etc., or evaluation, you don't have 100-pager or something that kind of a report. Your work, actually, the outcome of your work is reflected through the audit report. That is what the stakeholders really have. That is what is available in public domain for them to really make their decision. So you may say, I had done this, I noted this, I thought this was important. But if anything was relevant from a decision-making perspective, how was it presented in the financial statements? That's one bit. Of course, that's also where stakeholders will get the relevant information. But to the extent it was supposed to impact your audit report, it becomes very critical. So, like I said, the host of standards, I'm not going to get into SS700 in detail. That's a very basic standard that deals with a clean report. And hopefully many, many times we will be dealing with an unmodified report situation. But just 1 or 2 points which I want to highlight as far as SS700 is concerned from a conceptual clarity. One is that if you have to, over the last few years, the format did undergo a change wherein opinion comes first. And you have to really appreciate why these changes have taken place, right? There was, prior to SS700 being revised, there was this feeling that, if somebody was to really see what auditor is saying, they had to go through X, Y, Z paragraph before they can really get to know what the outcome is. And that is why they said, okay, let's bring the opinion right in front. Okay. So it is actually saying, this is my outcome. And then you are giving then the rest of it in the context of that opinion. So let's say if you've given a modified opinion, then of course your auditor is, or even a clean opinion, then the paragraph auditor responsibility, management responsibility will help a reader understand how that opinion was reached. Now, it may seem very cosmetic. Okay. Niche se opinion, you got it open, no, but trust me, in terms of readability, it does really have a lot of impact. Similarly, for example, the fact that the auditor's report is now called independent auditor's report, that again is not a cosmetic thing. It's not just one word added. It really stands out in the sense to say, okay, we have looked at it, and independence is such a hot topic today, especially with the regulator. So there are many of these things. And when you look at the SS700 elements, it may seem there are multiple. It talks about auditor's report. It talks about management responsibility. Auditor's responsibility, management responsibility, etc. But all of it is important. And over the last few years, it has only increased. Why? So everyone would have heard about this expectation gap, right? So what we believe as auditors, our duties are in terms of fraud and what the user may believe. Similarly, in terms of going concern, right? And therefore, what the reason the audit report actually, if you see some of the basic elements, they've been expanded, is actually to bridge this gap. It is not just to say, okay, you've kind of, just loaded it with words or extracts from the standard. No, It is actually to make sure a user who is not a chartered accountant understands what my responsibility as an auditor vis-a-vis going concern is. What is my responsibility when it comes to other information, the SS720 I was referring to. So all of them actually play a critical role in terms of bridging the expectation gap. Okay, so that was one. The second, or maybe the third, if I can just add, is that when you look at the framework, there are two frameworks that these standards acknowledge. One is called a compliance framework, and the other is called a fair presentation framework. Now, compliance framework, as the name suggests, it just says there the audit opinion would actually say you have looked at whether something is in compliance with something else. X is in compliance with Y, or the financial statements are prepared in compliance with X framework. You talk about, it's a very, as you can make out, it's more about talking about compliance in a very technical way. When you come to fair presentation talks about true and fair in a way. Okay, you're talking about whether it fairly presents. And true and fair view, frankly, is one way in which you can give your opinion in the fair presentation framework. There are two ways in which the opinion can be given. One is it fairly presents, and the other is true and fair. Now, what is the distinction between the two, apart from the fact that, like I said, itself, one is compliance, the other is fair presentation. In fair presentation framework, it acknowledges that the framework would allow you to add something which is not even required by standard if you feel it if it is needed for true and fair view. So let's say maybe there is no mandatory requirement, but I feel a particular disclosure is essential for a true and fair view. My framework does not stop me from adding it. So that's one criteria. I'm just saying there is a proper definition of fair presentation framework as well. And what we follow in India is the true and fair view is what we usually use, which is the fair presentation framework. So like I said, there are two conditions for a fair presentation. One, it permits you to give disclosures beyond what is mandatory. Second, in rare cases, that you can depart from the requirements of the framework in order to achieve a true and fair presentation. So this is what we usually refer to as a true and fair view override. Now, if you look at the elements of the audit report, it has a basis of opinion. Like I said, it talks about going concern, EOM, key audit matter, management responsibility. You also have your report on other legal and regulatory requirements. And I think in India, that becomes very, very critical. If you look at CARO, for example, I mean, it deals with matters, frankly, which go beyond true and fair. They deal with a lot of propriety matters. So let's say a loan given by the company, it may be correctly presented in the financial statement. So there is no impact on true and fair view. But is it prejudicial? Is it not prejudicial, etc.? There are many more compliances that you talk about in CARO. So, I mean, these are some of the elements which I wanted to highlight. The other conceptual thing from an SS700, which I may highlight, is that 700 deals with general purpose financial statements. Now, quite often I see people getting confused between general purpose and special purpose. Okay. Now, I'm not saying general purpose financial statements. I'm saying general purpose framework. Okay. So general purpose framework means it is a framework which is used by a large number of stakeholders for decision making. On the opposite side, on the other side, let me put it like this, you have another framework which is called special purpose framework. That framework, as the name suggests, is a framework which is intended to meet the needs of or special needs of a set of stakeholders. So let's say my banker says that, I understand this is how you provide for, doubtful debts, or what you call ECL and ADS. This is how you provide. For my purpose, I want you to follow a different, set or a different requirement as far as providing for bad and doubtful debt is concerned. They want us to follow something which is more conservative. And they say, can you prepare the financial statements using this provision framework and then give it to us? Now, that framework is intended to meet the limited needs of my banker. And that the principle they're asking to follow my general purpose framework. Special purpose framework by generally, like I said, would be intended to meet the needs of a specific group of users. Secondly, usually there will be a deviation from gap. Now, many I've seen tend to confuse between special purpose financial statements versus special purpose framework. So let's say I have a March year end, and I'm an unlisted entity, I don't need to prepare quarterly or half yearly financial statements. But my board wants me to prepare, the board of my client wants to prepare interim financial statement and asks me as an auditor to issue a report. Now, the fact is that these financial statements, if they are compliant with the general purpose framework, which is they're compliant with AS or Ind AS, whatever that applies to the company, my report on that interim will still be a general purpose report. It doesn't become a special purpose framework. So the point I was trying to make is that please make a distinction between special purpose financial statement, which is I am making it for it is not something that I do regularly, but there is no deviation from gap. The other is a special purpose framework wherein I am deviating from my normal gap. So that is what I just wanted to highlight. And there is a separate standard which deals with special purpose reports, reports under special purpose framework. That's SA 800, if I recollect. And that deals with, the other situation. But just wanted to highlight because quite often I have seen special purpose framework, SA 800, being used very liberally, even in situations where the general purpose framework should have been followed. Okay. So that was the other bit which I wanted to share. Now, when I was talking about the elements of audit report and auditor responsibility, management responsibility, I also spoke about going concern. While this is not an issue of reporting, but just wanted to highlight, quite often I've seen that as auditors, they would not take an assessment from the client on going concern. They would just start documenting their own assessment and then issue the report. So if you read the SS 700 standard paragraphs in terms of management responsibility and auditor responsibility, you will realize that it is very categorically stated that management has a responsibility to assess the company's ability to continue as a going concern. When it comes to auditor's responsibility, auditor has to conclude on the appropriateness of the management's use. So can you see the first is assessment has to be done by management and auditor concludes on it. And the reason why I'm highlighting some of these is when you go through NEFRA observations, you will find these are something very, very basic, right? But you will find these in NEFRA inspection reports as well. So please ensure that while you're concluding on appropriateness of use of going concern, it is appropriateness of management's use. So where is the management's assessment? That should also be appropriately documented. I missed one point which I didn't talk about because that's like a total different framework, is that in India, apart from the elements I spoke about, we also comment on internal financial controls. So financial controls, that is also very important. And there is a separate guidance note of the ICI on that. So that is one. I think if nobody has any question on SS 700, then I'll move on to some key points on 705. I don't see any question. Okay, I don't see any questions. So I'll move on to 705. Now, 705 is, of course, SS 705 is you apply when there is a modified opinion. Sorry, Shweta, can I maybe take a permission? I know there was a format to be followed. Can I just share one table? I know it's from the standard, not in a, but if you can give me sharing rights, I like to just put that on sharing for people to just refer to it. Can I?
I'll have to ask. Can we share a webcast? If Jaya has left.
I'll just put on one slide if it's fine.
No, but your slide I think will not be. Try it out if it's visible.
Yeah. So if you can see this. If you can see this, this is actually from the standard. And I just wanted to kind of use it as a reference point. Now, if you don't have a clean report, then usually you can have a qualified report or a disclaimer of opinion or an adverse opinion, right? Three opinions, which I would say are modified opinion. Quite often I see people struggling when to say I have qualified, when to say it should be adverse and so on. I'll address that. And the second issue, which I've usually seen, is there is a tendency to say, as long as I've put something in the report, I'm safe. Okay, what does it matter whether it's adverse disclaimer? They feel even if it's, let's say the situation requires an adverse, but you've given a qualified, there is a tendency to feel that, okay, as long as something is there, I'll be protected. And the similar thing, frankly, I have seen even with emphasis of matter paragraph. Something that requires a qualification, there is a tendency to say, okay, let me put in an emphasis of matter paragraph. They feel as long as something is coming in the audit report, that is good enough. But these are not interchangeable. They all serve a specific purpose. Emphasis of matter has a specific purpose, and these modified opinions and the category of the modified opinion also have a different perspective. So when I say a qualified opinion, I mean, I'm just saying in a very layman's sense, just think about it that, you've got something which is slightly defective. So you will say, okay, larger bit is okay. There is some problem, but the rest of it is largely fine. Okay. That is how I would typically look at a qualified opinion, that while overall it is, the larger bit is okay, part of it is an issue, but larger part fine. When I come to adverse is very clear that, this thing cannot be relied upon. The issues are so grave that you can't rely on it. So if let's say something which is, if you've got an issue which is, let's say, putting a gray shade on just about a larger part of the financial statements. Let's say you feel 70-75% of your profit or your net assets is something which is, which requires where there is a misstatement. Of course, you can't give a qualified opinion, right? Then it should be adverse. So it is about the gravity. And if you see this table, it says that you see the auditor's judgment about the pervasiveness of the effect or possible effect. So pervasiveness means obviously how widespread it is. If it is limited, then you can give a qualified. But if it is very widespread, then you cannot give a qualified opinion. The other word I want you to focus on this table, it is saying auditor's judgment about the pervasiveness of the effect or possible effect. There is a difference. When I talk about effect, it means you have been able to establish there is a misstatement. So let's say you're auditing and you clearly know management there is a misstatement in a particular way. They have accounted for a transaction. Very clear. The other could be that you are not sure, in the sense that, let's say, management has, there is a litigation going on. Management does not provide for it. And you are not very clear. Okay, you feel it may not go in their favor, etc. Or one is that you're able to make a judgment. The other is you're not able to make a judgment about the possible effect for reasons which are not limitation of availability of evidence. Or let's say that there is a fraud. You've been able to establish the fraud, but you have not been able to establish exactly the amount involved. So there is a possible effect, but you do not know how much that effect, exactly would be. So the judgment has to be applied for both effects as well as possible effect, and then you form your opinion. So effectively, what you have to do is, in the situations wherein, let's say the fraud bit wherein I spoke about, fraud has happened, but the amount has not been quantified. You make a judgment as to the rate for, right? So if you're able to make some kind of a judgment that, okay, my profit right now, let's say, is 100, I feel that if I was to account for this impact of fraud, the correct number could range from, let's say, 20 to 30 only rather than 100, okay? Or it could range from 80 to 100 or whatever. So somewhere you make that judgment about the potential impact or possible effect, like it says, and then decide whether the impact is pervasive or not. So to repeat, if there is a very clear misstatement or there is a possible misstatement, either which ways, you have to look at both, okay? You look at both and then you say, okay, the impact of this misstatement and possible misstatement, is the impact going to be material but not pervasive? You give a qualified opinion. If it is material and pervasive, you give an adverse. But let's say you are not able to conclude because there is a scope limitation, and that scope limitation could be within your control, could be, let me not say within your control, that scope limitation could be in the control of the management, or it could be outside the control of the management. Then you can give, looking at if it's pervasive, then you can give a disclaimer of opinion. But if the scope limitation is not pervasive, then you would still go to a qualified opinion. So I think this don't use it like a rude rule, but just if you see, this very beautifully captures the possible outcomes that you can have in terms of misstatement or possible misstatements. So this is what I wanted to highlight. The Institute has also issued an implementation guide on reporting standards, and I think that has some very, very interesting implementation issues. So just to take one or two, for example, it has also addressed that, let's say I have, like I was saying, some misstatements which are established misstatements and some are possible misstatements. Then what should I do? Effectively, it just says what I have explained before, that you take both. You take the effect and the possible effect of both, okay, together. You aggregate it and then you decide. So if the combined effect is such that it is material and pervasive, then depending upon whether it is a misstatement or a possible misstatement, then you'll do adverse or disclaimer. Let me take a very simple example also. Let's say I have a situation wherein the misstatement, established misstatement, very clear the company has not done the accounting correctly, is such that my profit will get wiped out by 80%. But I also have another modification where I'm unable to determine the impact. Okay. Now, can someone say, listen, I do not know what the impact of the second one is, and therefore I will give a disclaimer? No. Because by virtue of the known, the misstatement which is known, there you have no doubt. That itself is good enough in your case to know that 80% of your profit is misstated. That itself should take you to an adverse opinion. But let's say the misstatement is going to impact only 20% of your profit. Okay. Then I would say, okay, what is the impact of my other modification wherein I have a potential misstatement, not a established misstatement, and then see the possible effect and then decide whether to do a qualified adverse or disclaimer. Okay. So judgment becomes very relevant in terms of when you've just not got one, but maybe let's say there are multiple modifications which need to be considered while forming your conclusion. Now, there is also an interaction between modified opinion and your opinion on IFC. So one of the questions which comes up is that if I have a modified opinion, does it automatically mean that my IFC opinion has failed? Now, I won't say yes or no to it. In this case, I think it depends. You have to. But I would say it is a very strong factor that you would need to consider. So let's say if I say that there is a modification in the financial statements because the company has not correctly accounted for leases. Okay. Now, why have they not correctly accounted for leases? If the root cause is that they do not have the right technical skill sets, the finance team doesn't have the right technical skill sets, it would actually be indicative of a IFC weakness as well. So the point I'm trying to make is that you need to see why it has happened. But let's say if it is because the management and the auditor have a different opinion, which you can disagree, right? And it is very clear, management can demonstrate that they have the right experts, they took the right, it was a very complex transaction, they involved the experts which could be outside the company, etc. They've done the whole due diligence around it. Then in that case, even though there is a difference of opinion, it may not necessarily be an IFC weakness. So the point I'm trying to make is that if you have a modified opinion, it is definitely a red alert. You have to then go and assess the impact on IFC. Now, whether or not it gets affected will be case to case. Now, let me kind of flip it around. Let's say that I had an IFC modified report. Okay, there is a failure in my internal financial controls. Does it mean I have to issue a modified opinion on financial statements? Again, not necessarily. Okay. So let's say that if my controls, the controls of the company were not working well, and therefore I could not, while as in my audit, I could not place reliance on the controls, but I was able to perform alternative procedures. I did substantive testing, etc. And I was able to get comfort on that number, then I can still give an unmodified opinion. So there is an interaction. That's all I'm saying. There is an interaction between a modified opinion and an IFC opinion. You need to be careful that they are speaking the same language. It shouldn't be that it is very clear that your modified opinion was impacting IFC, but your IFC report is clean, or vice versa, right? So you also don't look at these opinions in isolation. Look at the impact on each other. One more bit which I may share about modified opinion is that I could have a situation where my PNL is, let's say, adverse, okay, but my balance sheet opinion is only qualified. And why is that so? That's because I will look at this impact, like it's given their effect or possible effect for each item of financial statement. Sorry, let me not say each item, but each primary statement. So balance sheet, PNL, and cash flow. I will look at it separately. So it could be that the item which is misstated, okay, why my margin or my profit is very, I have a very thin profit. My profit is very thin, but my asset base is very high. Okay. So it could be that the misstatement is going to wipe out, let's say, 80% of my profit, and therefore it is material and pervasive and I give adverse. But the impact of the same thing on the balance sheet is only maybe 10%, 5%, and so on. You know, when you move forward that misstatement and you look at the impact on balance sheet, it's only 10% or whatever. You can give a qualified. So you can also have a situation wherein the nature of modification on balance sheet and P&L or cash flow may be different. Okay. Any questions on modified? Otherwise, I'll share some more points on, I'm just looking at the time. I'll share some more points on, otherwise I'll move on to emphasis of matter paragraph. Are there any questions, Shweta?
I think you can go ahead. We'll take it at the end.
Okay. Then let me just stop sharing then. I will now move on to the emphasis of matter paragraph. Now, 706 deals with emphasis of matter paragraph and other matter paragraph. There was a time when they were initially introduced, these were considered as modified opinion, but they're no longer considered as modified opinion. The standard has since then been revised. Now, what is an emphasis of matter paragraph? as you would see from the name, it is something that requires emphasis. Effectively, and if you see the words these standards also use, they say it is fundamental to the understanding of the financial statement. So please appreciate the word fundamental. It is different from material. Every item which is material, you will not make it as emphasis of matter paragraph. So in a way, what SS 706 is saying that, financial statements are so large, there's so many disclosures. But if you would want the user to focus on something and then read the entire financial statement in that context, that is emphasis of matter paragraph. So for example, let's say that I'm just taking a very simple one. Let's say the company had a merger with common control merger and within a group entity, and they have restated the previous year. Obviously, I mean, it's a big impact because the financial which I had issued last year did not have that. Now, it may be so fundamental, they're saying, please see it. Or let me take a much more simpler one. Let's say your company had 5 divisions and they've hived off one in the current year. And that division which has been hived off represented, let's say, 20% of the total business of the company. Okay. So last year will show, P&L will show, transactions of 5 divisions. Current year, let's say you had disposed of this business in the first 2-3 months itself. Okay. So your performance obviously is not comparable because now you're showing a big chunk, which is 20%, has actually gone out. Maybe that is something you would want. That is so fundamental that you would want it to be. You're saying, please, before you even compare, this is so fundamental for you to be able to do any analysis of the financial statements. That is what they mean. It's like big ticket items like these that you would make as emphasis of matter. The reason why I'm saying this is that there is a tendency for very small items also to be at times reported as emphasis of matter paragraph. Now, when you do that, actually, then you take away the importance that emphasis of matter paragraph has. You are in a way doing away with its relevance. It just becomes more like just an attention matter paragraph that we had earlier. This is not the same. This is not the same as the attention matter paragraph that we did in, maybe a decade ago, whatever. So this is for something which is, like I said, fundamental to the understanding of the financial statements. Now, if I look at some of the examples in the standard, the reason why I'm taking this up is, again, because I've seen some of them using this example very liberally. If you look at some of the examples in the standard, it says an uncertainty relating to the future outcome of an exceptional litigation or regulatory action is one example of EOM. Now, what happens is that, let's say it is very common for companies to have some litigation, right? So effectively what had started happening was that many companies, if there is a litigation, they will not make a provision. They will give a disclosure. The auditor is, of course, worried, is a provision required, not required? There is only a contingent liability disclosure. They will play it safe by just highlighting it in the EOM. That is not the right approach. First, you have to make an independent assessment as to whether or not the litigation requires a provision or whether it's a contingent liability. EOM is not a substitute for making that judgment. If as an auditor you believe a provision should have been made, it should have been made. And if it has not been done, then you should have a modified opinion. You can't say, okay, I've highlighted something in the report. If regulator will ask me, I'll say, see, I brought it out in the report. That is not how it will work. And again, if you see here, it is using the word exceptional litigation. Not every litigation is exceptional. Maybe I can understand something which took place in the telecom industry, if you recollect, on the AGR bit. That was an industry-wide issue that had many fundamental issues were involved in it. Probably I could have thought about that. But every litigation cannot be considered as an exceptional litigation and then, company just does a contingent liability and the auditor does an EM. So similarly, if you see, I think this is an interesting one, early application of a new accounting standard. Now, why is this an EM? Because for comparability. Now, if you see, if it's an early application, companies in the same industry may not have all early applied. So your financial statements may not be comparable with the financial statements of another company in the same sector. And that is why they're saying if you early applied a new accounting standard where permitted, because it will take away comparability within the sector, please highlight it. It's so fundamental. And of course, I'm presuming that it says also that has material effect. So it is not that every, let's say there is a minor amendment and I early applied doesn't make it an EUM. So just look at it that it is something which you believe is so fundamental. You want your standards, your financial statements to be considered in this context, then you use it. The other is other matter paragraph. The other matter, before I go to other matter paragraph, as far as EUM is concerned, you can give an EUM only if the matter is appropriately disclosed in the financial statements. So if the management does not make adequate disclosures, let's say relating to this litigation, etc., or anything else, right? You can't say that, okay, I'll still give EUM and add details and no. If management has not made adequate disclosures, it may lead to a qualified opinion itself. So EUM can be only given if requisite disclosures have been made in the financial statement. So you can't use it for a disagreement very clearly. Other matter paragraph, on the other hand, deals with matters which are not disclosed in the auditors, in the financial statements. Now, these are usually intended to be more about, highlighting. I'm not saying that's the only one, but it is largely about highlighting the responsibility of the auditor, or let's say the auditor's report. That is what it is limited to, if you see. So let's say if I want to talk about in a consolidated financial statements, there are 5 subsidiaries which I have not audited. It talks about my responsibility. Obviously, why would management make any disclosure relating to it? So that is where you take it in other matter paragraph. So other matter is, like I said, something on which there is no disclosure. Unlike EUM, there has to be disclosure in the financial statement. So that is what distinguishes. And second is other matter paragraph. Like I said, it is not about financial statements. It is usually about the auditor's responsibility or the scope of audit or the auditor's report. I'm not going to get into where it should be placed, etc. Those are technical details. But this is what I just wanted to share. I think quite a bit I have already mentioned. It should not be used as a substitute for modified opinion, but there is usually a tendency to do that. So please be very careful. Then I've already mentioned, please, widespread use will diminish its importance and effectiveness. Use it only where the matter is of fundamental importance. It does not make the report modified. An EUM is still an unmodified report. So if you see EUM or other matter paragraph, it starts with the words, without modifying our opinion. And also, please take care that as auditor, we are not the first generator of information. The information should first come from the management. It should be there in the financial statements. Then you kind of refer to it. Please do not start putting information which management has not given to you or which is not disclosed in the financial statements. Now, I don't think we have time. I'm just trying to see how much time we have. I may not be able to go through key audit matters in detail, okay? But if I can just take 2 minutes and then I'll come back to the interaction between key audit matters. This is again from the regulator, this thing, only it's not mine. It is again from what IAASB has prepared, which I thought was very good. Now, key audit matter. What is a key audit matter and why has it been introduced? If you ask me, this is very relevant for, highlighting the value that an auditor brings. So over the last few years, there has also been a lot of discussion around the value of audit. Okay. What, whether as auditors, is audit only a compliance thing? What value does auditor add and so on? So there's a lot of been conversation around that. So key audit matter, while this doesn't apply to all companies, it applies to listed entities. It sought to actually address the value that the audit brings. Now, I said this even at the beginning of the session that you may do a lot of work, but what goes to the investor is just that few pages of that audit report. So the user of the financial statement, unfortunately, never saw, never gets, or let me put it like this, does not seem to get an idea about, sorry, give me 1 second, does not get an idea about what were the main issues that you encountered as an auditor. Where did you lose your sleep, right? Where is it that you had spent a lot of time? Because those issues are only discussed by the auditor with those charged with governance. Can you hear me?
Yes, we can hear you.
Okay, sorry, I can't see the screen. Okay, so so effectively to highlight the value that an audit brings, I think this key audit matter was really a step in that direction. Now, what is a key audit matter? Key audit matter seeks to bring out where the auditor spent significant time, and I'm just using significant in that sense. I'll come to that, the technical words, just in a minute. So they said effectively, let the audit report also speak the story of the audit. Each audit has a different story, right? So they said, let that story come out in the audit report itself. So if I'm doing, say, the audit of a large listed entity in pharma company, or I'm doing the audit of a large listed entity in, let's say, maybe telecom, the issues could be very different, right? How did I deal with it? Was impairment an issue? How did I address it? And, while ultimately I'm just giving a true and fair view, that is one line, but they wanted to know the story behind that true and fair, that one line. So they said, effectively before this SA701 came in, it was felt that the report is boilerplate, which it is, right? Because it just has the standard template. And they said it is a binary opinion. It is pass or fail, right? It is either a modified opinion, it is not a modified opinion. But the qualitative aspect of audit doesn't come out in the report. And key audit matter seeks to at least just do that. So effectively, this standard requires that matters, again, please concentrate on the words, matters which are of most significance in the audit of the current period, those are called key audit matters. Now, how do you identify most significance? So as you can see from this funnel thing, which is there on the slide, your starting point usually is the matters which you would have discussed with those charged with governance, because obviously if it is an important matter, you would have discussed with them. That becomes your starting point. Now, you may take 10, 15, 20, whatever number of points to those charged with governance. Are all of them CAM? No. So what you do is, out of these matters which you took to them, because some of them could be regulatory requirement to let them know, you may let them know, but it is not most significance and so on. There could be many matters on which you have to just simply update them as well. So out of those, you identify, in a way, when you refine the also, don't you do that, Shalini says? So it's like same thing. You kind of say, okay, out of that, I'm going to take out matters which required significant auditor attention, okay? Which means they required, as the word says, significant attention. But then you further filter them and you say most significant. These are those 3 or 4 topics or matters or issues, whatever you want to call it, which would have got you to lose your sleep. And I say lose your sleep in the sense wherein it could be very contentious, very senior partnership were involved. It required maybe consultation with EQCR. It required maybe use of an expert. It was not just, it was something that was of most significance, very simply. Okay, I can't think of any other adjective other than this. So in a way, you start, like I said, with matters communicated to those charged with governance. See, then out of that, you filter what is significant attention. And out of that, then you filter further, which is of most significance. So by doing this, you are letting the investor know And why? How does it help the investor? One is that, of course, it tells the story of audit. Where did I, as an auditor, where were the issues where my judgment was involved? Where were the issues which required maybe going back and forth with the with those charged with governance, and maybe they were complex. I needed to involve experts, etc. But it also tells the investor these are the areas when the investor, let's say, is engaging with the management directly, they also know these are the areas they want to focus on. So it also tells them where they have to put their attention. Now, this key audit matters is not as easy as it sounds, because obviously anything that you'll put out as a CAM, is the management would be sensitive. So this obviously requires that you have a very timely discussion with those charged with governance as to what are those matters which you will take to CAM. The drafting of it can be very critical. You can't just draft them very loosely. So the effect of this key audit matter that at least we realized was this increased the interaction between the senior audit team. I mean, if let's say the partner, etc., with those charged with governance. So it required more interaction, and required more time on these matters. So these are definitely very sensitive. And therefore, it would make sense if you were to take these to those charged with governance as early as possible. In fact, on modified opinions also, I should have mentioned that there is an obligation that if you think there is going to be, if you think there is going to be a modified opinion, SA 260 would require you to inform those charged with governance. So unfortunately, this SA 701 is not, it was intended, like I said, to be a, where you will tell your story. Each was expected to be different. So if in key audit matter, you mentioned what was the key audit matter, why was it a key audit matter, what did you do to address it? And, key audit matter is not like to say revenue was a key audit matter. What within revenue was it measurement? Was it identification of performance obligation? Was it timing of revenue? The more granular you are, the more relevant. I think there is still, when I look at audit reports, at times I see key audit matters like a pura financial statement item you mentioned with your PPE, intangible. No, I think you have to make it very granular. And then also mention what did you do to address the reason why this was a key audit matter. So over the years, I've seen some bit of it again becoming boilerplate, which if it does, it'll be sad because it'll lose its relevance. I think the intention is that it should speak the story of the audit. It could be something was a key audit matter in company A in year 1. It may continue in year 2 as well, but it may not continue. Depends on the nature of that key audit matter. Some are going to be common across sector. Some will be specific to the company. Some will be common over years. Some will keep on changing over the period. So I think this identification and drafting is very critical. And that is what I had. I think if there is still, I don't think we have time. Otherwise, I would have spoken about SS 720 as well, but we don't have time. If there are any questions, maybe we can take it up at this stage.
Thank you very much, Archana. We'll just wait for the question answers. Jaya, can I?
And may I request that, I know initially we were also thinking whether it could be a general interaction session as well, in terms of any softer skills also. So if anybody wants to talk about anything in terms of the profession, I'm happy to even discuss that. If you don't have a question on reporting standard, would just like to discuss opportunities in the So Shweta, I'll hand this back to you. Frankly, I can go on for another 1 hour. I have more to say. I've only touched very small points. I don't think they're very limited points which I have covered. This is definitely, I don't want the audience to go back thinking it's comprehensive, not at all. I've only covered some key points. And I can speak another hour or 2 on reporting standards, but I'll stop here. If anybody has any questions, I'm there for another 10 minutes. And while we move on to the next session.
Thank you. Archana. I'm just calling to Jaya. So let me check with her first. So currently, we don't have any question answers. So Wrinkle, you can take it up with formal vote of thanks and further session. We are not able to hear you. You're on mute.
Now,
Yes.
thank you, Archana ji. Thank you very much. You are amazing in standards. You explained them and made them clear in brief so well. The difference between presentation and the compliance, how the audit report should be reported, the differentiation between adverse, qualified, disclaimer. We always have this issue while we are concluding the audit, whether would it be adverse or would it be qualified. And the most important, it can be different for both balance sheet and profit and loss account. Till date, we always felt that, oh, it has to be for a complete financials, but it can be differentiated, very well explained, and also the key audit matter was present in a beautiful flow chart rather than pointers that made it very enjoyable and learnable a lot. Thank you very much.
Thank you.
Hi,
I'll just
Archana.
take
This is
30
Prachi.
seconds. I
Pleasure
just want
meeting
to
you.
thank everyone for such patient hearing. It's easy for me to talk, but I think for the listeners, that patience is really, thank you so much.
You were excellent. That is why the patience was not required. Plus, those drawings and the diagrams that you presented made it much more interesting.
Thank you.
Hi, Archana. This is Prachi.
Hi,
Yes.
Praj.
Yeah, hi.
Hi.
I think Wrinkle had, she said that it's very well explained. Audit sometimes become a little subject which has nothing related to it, but I think that the way the flowcharts are being presented, though I joined a little late, it's little interesting. I mean, you made it interesting.
Thank you so much. Thanks.
Since we are moving in the question answers, so we have also Prachi, CA Prachi Jain. So I would just like to introduce her. But before that, Shweta would like to say a few words.
No, I think we can directly start another session.
So I'll stay to another 10 minutes, Prachi. It'll be a pleasure to hear you, and then I'll move on.
Sure.
If it's
Thank you so much, Archana.
Thank you.
So CA Prachi Jain is the co-founder and CSO of Edwinot EdTech, celebrated
Innovate. Yeah.
Ednovate EdTech, celebrated as one of the top 100 women in finance in 2020 by AIWMI and honored as one of the Mumbai's leading women in 2022 by the World Women Leadership Congress. With an impressive career spanning over 15 years, the realm of private equity and venture capital impact funds, Prachi's legacy includes associations with prominent names like AWE Funds, SAEF Fund, and Yes Fund. She boasts a formal track record, having raised a staggering USD $65 million and strategically deploying $26 million to nurture various portfolio companies. Beyond a financial acumen, Prachi is a recognized speaker, mentor, jury member, advisor, and an angel investor, leading her expertise to platforms like IIT Kanpur, FICC iFlow, ACIWE Hub, and STEP. With a zeal of fostering the entrepreneurship spirit, she has been an unwavering pillar of support, mentoring, and guiding entrepreneurship across sectors. Her academic and professional credentials speak volumes. She is All India ranker in Chartered Accountant and Company Secretary. She also possesses a bachelor's degree in law and a master's degree in finance. She is the recipient of Global Gender Lens Investing Fellowship Asia 23 and recently completed entrepreneurship program at IIM Bangalore 10K Goldsmith Sachs program. Prachi Jain epitomizes leadership, commitment, and a relentless pursuit of excellence. Thank you, Prachi. We really welcome you at this Sky's Person.
Thank you so much, Wrinkle, for the kind introduction. And yeah, here I am talking about something which is very, very close and close to my heart. I'm passionate about it. I've worked in this industry for 15 plus years. And I think the first step to start a fund is the structuring of the fund and to understand the nuances of it. If someone can give me the screen share, it's with me, so I can just share my screen. Everyone can see my screen? Is it visible? Okay. So I'll just start. I know Virat is at 97. 3 more runs to go for its century to just happen. I hope we won. It's the semi-finals for us. India is there, and I think we are here. And I think all of you are patiently listening to these webinars. So kudos to you, and thank you to your commitment to this particular profession. We are all glued to the screen and hope that India wins today. With that note, I kind of start. I want to make it very interactive, and I just wanted to tell that alternative investments. I think this is something which people felt that just started in 2012 when this regulation of alternative investment fund came in. But I think let's go back to the history dated 1996. That's the point in time the SEBI venture capital fund regulation was kind of introduced by Securities and Exchange Board of India to pool in capitals in India. And this was the time when people were not actually actively looking at India for investments. But as I was hearing today, that India has always been far ahead of its time. So this regulation was always in existence, but I think it was people started using it, or maybe people started using it at a root in 2005. And why that happened? It happened because in 2004, the largest block deal of value of $2 billion happened by the largest private equity fund called as Warburg Pincus Fund in India, wherein they exited from Bharti Airtel. And I think this was the inflection point for India, wherein the global investors started looking at India positively and started thinking that this is the place where they could make money. And 2005 is the time when this asset class, which was erstwhile called as venture capital fund and foreign venture capital fund, started like, I mean, a lot of investors, private equity funds started looking at India very positively. And 2005 like opened up that floodgates for India, wherein a lot of private equity investors came into India. FDI regulations were relaxed so that there's a lot of clarity for foreign investors during that point in time. And a lot of sectors were bought under the automatic route. And sensitive sectors like defense, land, acquisitions, real estate, I think all these were opened up with certain restrictions associated with this. And this, I'm talking about 2005. There was this heavily announced press note 2 of 2005, which actually brought a lot of investors into the real estate and infra sector, which was the need of the hour, because you really need, other than the public-private partnership, you also need foreign investments to come into India. Other than the FII, you really need investments to be put into the companies, and that is only possible through these through this particular route. I think in 2012 around, SEBI was actually looking at this particular regime very seriously, and they repealed venture capital fund regulations and introduced what is called as Securities and Exchange Board of India Alternative Investment Fund Regulation, which we now call as AIF regulation in 2012, to provide more clarity and to cover the ambiguities which are available in the earlier regulation. So what I really want to talk about is, I don't want to make it very, because this becomes a little heavy because you're talking about regulatory restrictions and all. I'll come to the fund structuring, but prior to that, what you really need to understand is what is an alternative investment, what is an alternative investment fund, how it is regulated, what are the investment restrictions, what are the different categories AIF, as we commonly call as the alternative investment fund, is called as an AIF. And then we'll come on to the structuring part, which is primarily same for all the funds. But we'll pick up just one out of it, which is the angel fund, because that is something which is picking up. I'll explain how it is being done, and then I'll open myself for Q&A. So I think this is the part which I'm trying to follow. So what is an AIF? So as per the AIF regulation, an AIF can be a fund, like you have to create a fund which is established in the form of a trust, or it is a company, or it is a limited liability partnership, or a body corporate. Just to let you know, in India, 95% of the funds are created in the form of a trust, and these trusts have been accorded a pass through status that any income which is being earned by them will not be taxed at the fund level, but will be taxed directly at the beneficiary level. The other, like a company, LLP and body corporate, I think 5% of the total funds which are set up in India would be setting up as a company or an LLP or a body corporate. However, as per the definition, you have to say that it's a trust, company, LLP, or a body corporate. What was the purpose of setting up an AIF? The primary purpose is to it's a privately pooled investment vehicle which collects money from the investors. Now, someone may ask, who are investors? So those investors could be your domestic investors or international investors or non-resident investors. These are investors who are keen to make investments into India through this route, and the fund needs to invest as per the investment policies for the benefits of the investors. So there's an investment policy which is being defined by every fund on the basis of which they make investments. Take, for example, there would be a fund which says that I will only make investments in food and agribusinesses companies. So that's the investment policy or thesis of that fund. So assuming if this fund makes investment into an infrastructure or a real estate project, then it is not following the policy, investment policy, and therefore those investments, the investors will not give approval for making those investments by the fund. So this is broadly, I'm trying to make you understand how this works. Now, coming up to what is not covered in the AIF, right? So something which is being specifically covered by SEBI, which is a mutual fund regulation. So if it's a mutual fund, it's not an AIF. If it's a collective investment scheme, if it is a CIS, then it's not an AIF. Or any other regulations of the board which regulates the fund management activities, like investment manager, investment advisors, or what you call it as the portfolio management services. So these are not covered. However, there are certain exclusions which are specifically being provided, and these shall not be covered. Like family trust will not be covered in the definition of an AIF, though they may pool funds and make investments. ESOP trust will not be covered because the primary purpose is for the welfare of the employees, which is employee stock option plans. Employee welfare trusts are also not covered, with primarily all gratuity trust, which is for the benefit of employees. Other special purpose vehicles not established by a fund managers are not covered. Fund managed by a securitization company or a reconstruction company, which is ARC, which is governed by the ARC regulation, is not covered within this ambit. Any such pool of funds which is being regulated by any other regulation in India or regulated in India, it is not covered. So it is very, very specific that if it has to be an alternative investment fund, the person or the fund needs to get itself registered under the AIF regulation, which is Alternative Investment Fund Regulation of 2012 by SEBI. Now, there are three categories of fund which you really need to understand. So under the AIF regime, which is the Alternative Investment Fund regime, there are three categories of fund. One is category 1. So you can either register yourself under category 1 or under category 2 or under category 3. Apparently, category 2 is the residual category. So even as you see the definition, it states anything which doesn't fall in category 1 or category 3 is category 2 fund. Before going on to the definition, let me talk about the types of category 1 fund, category 2 fund, and category 3 fund. And this bifurcation is really, really important for you all to understand when you are taking a decision whether you want to set up a category 1 AIF or category 2 AIF or category 3 AIF. So as I say, category 1 AIF typically includes an angel fund, venture capital fund, SME, which is a small medium enterprise fund, or a social venture fund, or an infrastructure fund. So if the investment thesis of the fund or if the investment policy of the fund is any of these above, then they have to get themselves registered under category 1. For the purposes of category 2, the types is primarily a private equity fund, as I spoke earlier. Like earlier, it was under venture capital fund regime, or it is a structured credit fund, which is giving debt or credit, debt funds, or a real estate fund, which falls under category 2. So if you are very clear that these are the 4 types you want to set up as, then you have to set up under category 2 and not category 1 and category 3. When I talk about category 3 is very, very peculiar, and it talks about the long only funds, long short funds, hedge funds, and other funds. So the category 3 is primarily for the hedge fund category. Now, coming to the definition, once you've understood, you have to keep in mind the various types, and now we'll go on to the definition. So when I talk about category 1, it says that category 1 is an AIF which invests in sectors or areas which the government or regulators considered as socially or economically desirable. So in quotes, any fund which want to set up themselves in sectors or areas which are considered as socially and economically desirable, then they have to set up as a category 1 fund. And as I said, that the example being a startup or an early stage venture, social venture, SME, infrastructure, or other sector. Now coming to category 2, as I said that it's a residual category. So it's neither 1 or 3, then you're falling under category 2. But this is also the category which raised the maximum amount of funding. As on date June 2022, category 2 funds have raised more than 2,30,000 crores of fund, have been routed through this particular structure in India. Category 2 feature, another feature is that category 2 fund, they cannot undertake leverage or borrow other than to meet the day-to-day requirements or as permitted under the regulations. So what does this mean? This typically means that I cannot lend money. I cannot borrow money to lend it to somebody or to give it to someone. The only lending or borrowing I can do is only for the purpose of meeting the day-to-day requirement. Category 3, as I define is, as I say, it's more like a hedge fund category. It's not very prominent fund structure in India, but this particular category is being picking up over a period of time. This primarily employs diverse or complex trading strategies, and they can actually employ, they may employ leverage, including through investments in listed or unlisted derivatives. So derivatives, options, forwards, I think this is the category very, very prominent under category 3, which is there. Application fee, when you want to register yourself, you have to make an application in form A, which is provided in the regulation. And while making an application and putting in all the details in the application, while you're submitting the application to SEBI, you have to give them a fees of 1 lakh rupees. It is same across the category, because SEBI is processing your application. They may either accept it or reject it, but there is a certain amount of work which goes in evaluating the proposal, and this application fee is non-refundable. This is what you have to give to SEBI to ensure that they appraise your proposal, and if it's good enough, they may accept the proposal, and then they may ask you that you could be registered. At the time of the registration, you have to give what is called as the registration fee. So you'll receive a letter from SEBI that your application has been processed. In order to receive a SEBI certificate of category 1, 2, 3, you have to provide a registration fee. So for category 1, it is 5 lakhs. Under there is a subcategory of fund under category 1, which is an angel fund. The registration fees is only 2 lakhs. For category 2, the registration fees is 10 lakhs. And for category 3, the registration fees is 15 lakhs. Now coming to, I think, a very interesting distinction between the two, wherein Cat 1 and Cat 2 are more or less similar. And Cat 3 have its own, a little different from Cat 1, Cat 2. Whether these funds, Cat 1, Cat 2, Cat 3 AIFs are close-ended, open-ended. These are all close-ended funds with a minimum tenure. However, category 3 funds, which is more like a hedge fund category, could be either open-ended or close-ended. The minimum tenure for Cat 1 and Cat 2 is 3 years. For Cat 3, it depends. If it's open-ended, there's no tenure. If it's close-ended, it depends at 3 years plus. The investment amount, so it typically defines, like, I'll just explain you in a while. I'll just go to the investment structure so you can understand this slide a little better. What is the whole purpose of pooling those funds into a fund? So when all investors come together and pool a fund in an AIF fund, the entire purpose is to deploy that amount of money into companies, or what we call in layman's language as startups, or early growth companies, or a Series A, Series B companies. I mean, this is the nomenclature which is being used in the industry. But for a fund or a fund manager, companies in any of these categories are called as either the investee company or the portfolio company. So the maximum amount of investment in any portfolio company by a fund could be in category 1 and category 2. The investable funds in any investee company should be less than or equal to 25% in that, but 25% of the entire corpus. So assuming if the total corpus of the fund is 100 crores, then in one the maximum amount of investments which you can make in one particular company is 25 crores. Of course, the lower amount is always allowable, but this is the maximum amount because you really need diversification, because you are using other people's money. So there is a fiduciary duty which you have to have, and therefore there is a restriction limit to invest only 25%, maximum of 25% in a particular company, either directly or through investments in the units of AIF. However, if it's a large value fund for accredited investors, then this amount it could be like 50%. When I speak about accredited investors are those investors who understand this particular field pretty well, have a good amount of experience, and they have a net worth of X amount, and the way that is being defined into the SEBI regulation. So for them, 50% is still allowable in a particular company, assuming it's a real estate project or an infra project. It is allowable. So Cat 1, Cat 2 have a similar kind of investment amount. However, for category 3, this is less than or equal to 10%. And for the large value funds for accredited investors, it is equal to 25%. Other investments, so for each of these categories, these are broader terms, but within them and under subcategories, the types which I spoke about, there may be further investment conditions applicable to each of these categories. And any person who is setting up these funds have to abide by those conditions and also put it as a part of the PPM, or what we call as a private placement memorandum. Further, to tell you that the minimum tenure is 3 years, the maximum tenure could be 8 years, 10 years, 12 years, because it is a close-ended fund. The life of the term is fixed on the date you are setting up the fund. So that is being predetermined. You have to put it in the private placement memorandum. However, AIF may be permitted to increase that to 2 years. So if your life is 10 years, you can extend it further by 2 years, which is 10 plus 2. However, such extension may need approval of 2/3 of the unit holders by value of the investments in AIF. So when I say value, assuming there are 10 investors in a fund and the fund size is 100 crores, the 10 investors equally own 10, 10, 10, 10, 10. So 2/3 holders from the value. In a scenario where one investor owns 40 crores, another investors own 20 crores, and third investors own 30 crores. So in this scenario, by value, 40 plus 30, so 70. So 2 plus, if 5 also agrees, then only you are able to extend. Otherwise, it's impossible for the fund to extend its life, because as per the regulation, you need 2/3 of the unit holders' approval by value if you want to make that extension. Further, as I said, that the large value funds for accredited investors can also enhance it by 2 years, but then this is subject to the fund document conditions like a contribution agreement, PPM, or what is provided in the other documents which is being executed with the investors. Now, I think this is some data statistics which I thought is very, very relevant. As on October 2023, we have 1180 alternative investments funds registered with SEBI. That's a pretty huge number. The total in different categories, as I just spoke about, the commitment raised is in category 2, as I was kind of mentioning, is 5,61,900 crores, which is a huge amount which is pumped up into India by either domestic or foreign investors as a different asset class. Of course, this is a very small basket of the listed space, but this is kind of picking up in India. The funds raised is 240 in category 2 and investments made is 220. So category 2 is definitely the one wherein all want to get into, and that's where the private equity of the world work, as I kind of just discussed earlier. Category 1, 58 crores, and this is an upcoming category, specifically the angel fund, the angel platform, and SEBI has taken a good step in terms of defining, because earlier people were using various routes and kind of circumventing the laws to ensure that angel platform is created and people are kind of making investments through different entities, creating an LLP and other kinds of structures. But I think with this AIF, SEBI AIF angel fund, there's a lot of clarity which is being provided, and flexibility is being provided to investors who want to be part of the platform and then raise, can kind of invest in portfolio companies. Category 3, as I said, it's a hedge fund category, of course, a very minuscule of the total listed space, but this is also picking up. Yeah, so I think this is the data which is related to, primarily related to the various categories of alternative investment funds in India. And now I want to talk about, before I kind of get into this, let me just talk about the structure, which is very, very important. And this is a typical AIF structure, though I've written angel investors, because I wanted to project this as a angel investor platform, but just consider this as a very, very important structure for any Cat 1, Cat 2, Cat 3 fund. In what you have is the angel fund, which is in between, or you call it as any fund, category 1, category 2, category 3 fund, which is typically set up as a trust, as I just spoke about. The pooling happens into this fund, which is the angel or AIF or a private equity or a venture capital fund. There are angel investors. They could be individual investors having net worth of X amount, depending upon the kind of fund it is. Since here I'm talking about angel fund, for the angel fund, the net worth of an institution or a body corporate needs to be 10 crores. For an individual, net tangible asset needs to be 2 crores, excluding the residential house in which he or she is staying. And a SEBI registered AIF can also invest in an angel fund. So that route is also possible. What are the kind of documentation which you need to add? What are the entities which is being required? So let me just talk about it one by one. Fund, because it's a fund which is set up as a trust, which is a pass-through entity, will have to be managed by someone. So what we have is called as an investment manager. As you see in the green thing, there are two entities, sponsor entity and a management entity. So investment manager is the one which manages the assets of the fund. And when I say assets, it means the fund of AIF. The investment manager team needs to have requisite experience of working in this segment for up to the key management persons have to have an experience of 10 plus years, need to be in finance sector, and there are various conditions which is being provided. They need to be a fit and proper person, and they have to abide by the ethical code of conduct. So investment manager is primarily the one with whom the fund executes the investment management agreement. So the fund says to the manager that, boss, I am appointing you and your team to manage the funds. So the fund raises, so AIF will raise the fund, and manager in turn will manage the fund. It may advise or it may manages the fund. Okay. The sponsor, the second entity which you spoke about, is a sponsor entity, which is the sponsor of the fund. The sponsor of the fund and the investment manager may not be the same entity. If it is the same entity, it is fine. If it is not the same entity, a sponsor may be an individual sponsor, a sponsor may be a corporate sponsor. Then that sponsor entity has to have a continuing interest in the fund. And when I say continuing interest, it implies that till the life cycle of the fund, it needs to have that interest intact into the fund, or what I call as a lock-in of that particular amount into the fund. So this is the investment, the investment manager, which is abided by the investment management agreement. The sponsor may be same or a different entity. The angel fund, because it's set up as a trust, it doesn't have its own existence. So what you need is a trusteeship entity, which is called, in a charitable trust also you have a trustees, right? So in a similar manner, you need to have a trusteeship entity, For a fund, there are a lot of entities which provide trusteeship services, and whomsoever entity which you kind of assign or appoint becomes your trustee, and the fund, the way it enters into a management agreement, the fund and the trustee, like it's there will be a trusteeship agreement of the fund, and the trusteeship will render certain services to the fund. So this entire this entire documentation needs to be in place. So the entities is fund, which is set up as a trust, the manager, which can be set up as an LLP or a private limited company, a sponsor entity, again, if it's same as a manager, can be set up as an company or an LLP. If sponsor entity is different and it is an individual, then it is an individual entity. And as I say that there are certain documentation which a fund needs. A fund needs the following documentation: the investment management agreement, which I just spoke about with the investment manager. It needs a trusteeship agreement. The fund needs a trusteeship agreement with the trustee company. They also need what we call as a private placement memorandum. So if it's a company, the charter document is your memorandum of association, right? For a fund, the charter document is the private placement memorandum. It covers everything with from investment restrictions to investment thesis to fund strategies. Everything gets covered under the private placement memorandum. It needs to be as exhaustive as possible. You would have heard this word of private placement memorandum, or the PPM, in the listed space, when somebody is kind of the draft red herring prospectus, as we spoke about, wherein you're putting in all the details when the company is going in for an IPO. In a similar manner, you can just kind of relate that to a PPM, which needs to cover all the details about the company, the investment thesis, the team details, the core team, the key managerial persons, who is the investment manager, the details about the investment management team, the trustee company, the details about the trustee, the trustees on the board, the way the decisions will be taken, the investment strategy, which may include which areas or sectors you will be making an investment. So this is a typical AIF structure. There is no rocket science. In 1996, if there is a foreign, so this is a structure which just talks about investors. Now, when I come to investors, the investors may be domestic investors or it may be international investors. If they're domestic investors, we don't have to think about anything. If it is an international investor who proposes to invest into India, erstwhile there used to be an FVCI structure, foreign venture capital investment structure, which is being repealed when the VCF regulation got repealed. So what typically these people do, they either set up the international investor, set up an entity in a tax efficient jurisdiction, which is typically Mauritius, Singapore, Luxembourg, depending upon, or Cyprus if they are debt funds. They set up their funds there, pool in the entire international investors' money there, and that entity in turn will make investments into the AIF in India. This is one peculiar structure. But this happened prior to, as India, we do not have the something what we call as an IFSC zone, which is now is the GIFT city, which is in Gandhinagar. And we can actually use that as a structure wherein the pooling may happen in that particular AIF, which is set up in that particular zone in India, but it is regarded as an entity set up outside India. So you can pool in international investors' money there, and that pooling vehicle in turn will make investments into the domestic AIF in India. So you may have two legs of AIF. One is for pooling domestic money. One is, so these would be a parallel structure. One is for pooling in the international money, and that international pooling vehicle in turn will either parallelly make investments as the domestic fund make investment, or which we call as a parallel structure, or what they do is the international pooling vehicle will invest the entire chunk of money in the fund, which is the domestic AIF fund, and then the domestic AIF fund will make investments into the portfolio company or the startups. So this is called as a unified structure. So either we follow a unified structure or a parallel structure. What we really need to consider is the tax regime, the tax implication, which I think is a different discussion altogether, which I'm not going into, because it can be as exhaustive as the discussion only on the structure today. So there's a lot of things which gets into all these value kind of structure. So as I said, that this is what I spoke about, is the angel fund structure, but then this is across the spectrum which you can use. Now, talking about a fund strategy, I spoke about the private placement memorandum, which is a very, very important document for investors to read and decide whether they want to make investments into that particular AIF or not. So what AIF and fund kind of sometimes get with a capital F, so I'm capitalizing the fund, get interchangeably used. What do the PPM includes? As I said, the investment strategy. What is the strategy where you want to invest? What is the investment purpose, short term, long term? Investment methodology, how you are going to make investments. And this is the charter document which, after the investors read, they kind of take a decision whether to make investments into the fund or not. Of course, when I talk about investment strategy, it could be a gender lens focused fund that I am sector agnostic, but I'll make investments in companies which follow gender lens. Or I will only invest in companies which are only climate related companies. So these could be the strategies, right, in which you can invest. The most important thing is that once you have filed the PPM with SEBI and the approval is being received, you cannot change the terms the way you cannot change it in MOA of the company under the Companies Act. If you want to make any material alteration, if it is like a team member coming and going, which is not a material alteration, but because team needs to be part of the PPM, and if it's not a key management person, it is okay. But if it is a material alteration, which includes change of the key management person, change in the investment strategy, then you need, as I discussed earlier, consent of at least 2/3 of the unit holders by value of the investments in the AIF. Then that's the only way you could change the terms or the conditions which is being provided in the PPM. Otherwise, it is not allowed. Now, there are certain restrictions or investment conditions, I would call it, which is very important for any one of you who's proposing or planning to set a fund in India needs to consider. So what is the corpus? So we often primarily use this term, and I'll kind of use these terminologies also. So corpus is key. How much amount you propose to raise. So that's the corpus of the fund. So if I say my fund size is 100 crores, which implies that the corpus of my fund is 100 crores. Okay. So the minimum size for each scheme should be 20 crores. For a social impact fund, which is a one subcategory, the minimum is 5 crores because it is the social space. There may be a possibility they may not be able to raise more fund. Therefore, the requirement there has been reduced to 5 crores. The investors, the fund needs to issue units when they are kind of giving money or investing into the funds. So the AIF will issue units to the investors, and these units, as per the new amendment in the regulation, needs to be issued in the dematerialized form. Social funds can issue social units. The investment amount, which is very important. So people often ask, how much amount could I invest? How much money do I need to have to make investments into these alternative scheme? Because when I speak about mutual fund, there is a step I can invest 500 rupees, 1,000 rupees, 2,000 rupees. So I think this is very important. So first of all, you need to determine whether you are being regarded as an accredited investor or not. If you are an accredited investor, then there is no limit which is applicable to you, because SEBI thinks that you have the knowledge and you can take your own call. So there is no limit. However, if you're not an accredited investor, then the minimum you really need to invest is minimum of 1 crore rupees in any fund which you are investing. If you are an employer director of the AIF or investment manager, so like I have worked in fund as a part of the investment management team, because typically fund do not have a team. It is always the investment manager wherein the team resides. So as a director of the investment management team, because I'm an employee or a director, I don't have to invest 1 crore rupees. I can be an investor by investing just 25 lakh. That's the minimum amount. If I want to make it invest more, I can do that. For social impact fund, which invest only in securities of not-for-profit organization, that amount is only 2 lakh rupees. And as I say, because a social fund, they want to give relaxation and also promote the fund activity in that particular space. So that amount is pretty less, which is 2 lakh. In the earlier slide, when I was discussing about the fund, I spoke about the continuing interest of a manager or sponsor. So category 1 and category 2, the minimum amount which a manager or a sponsor, typically this is to a sponsor. If manager or sponsor are same, then it is one and the same. However, if they're not same, then the sponsor has to invest lower of the two, either 2.5% of the corpus of INR 5 crore, whichever is lower. So continuing my example, if the corpus of the fund is 100 crores, then the minimum amount a sponsor have to invest in is 2.5%, which is 2.5 crores or INR 5 crores, whichever is lower. So minimum amount which they have to invest is 2.5 crores. For category 3, because it's in the hedge fund, more into listed space, maybe open or close-ended, this amount is slightly higher. It is 5% of the corpus or 10 crores, whichever is lower. Plus, SEBI has also provided, because I think we are all smart enough to always find jugaad. I mean, Indian as people, we always think that there's always that jugaad which we could work on. So SEBI specifically says that I really need one sponsor for your fund who truly believes in you. So it should not happen 5 people have come together who do not have the requisite amount of money, but they will say ki kuch nahi bhaiya, hum log management fee jo. So typically the management fee is 2% per annum, which you will get as an investment manager. So if investment manager and sponsor are same, you will say that I am also the sponsor of the fund. And what you do is you waive off the management fees, stating that unless that amount of 2.5 crores or INR 5 crore, whichever is lower in this scenario, 2.5 crores is met, I'm not going to take any management fee. So SEBI has specifically said that I want to see your net worth of a sponsor. So if your interest is through waiver of management fee, it is not allowable. Please don't come to me if you do not have that. So they want serious money to get into this, and serious people, because they're managing, they are into the fiduciary responsibility or fiduciary duty to manage other people's money. So they want that there is skin in the game, and they're just not playing with people's money. So they want that sponsor money to be put in, and sponsor need to have continuing interest. They can't say today I'm there, tomorrow I'm not a sponsor for this fund. So they need to have continuing interest through the life cycle of the fund. When I say life cycle of the fund, it is the tenure of the fund, which is 10 years, as I just gave an example earlier. Number of investors is, it could be a maximum of 1,000 investors which you can have in a fund. But typically it's very, very difficult, because then it becomes kind of a mutual fund. I think this 1,000 investors limit is more for angel fund platforms where you have more people. But when I speak about private equity fund, these are all broad-based funds. When I say broad-based, they primarily raise money from institutional investors, and the maximum number of investors you may have is around 10. 10 is the maximum, 10 to 12. I think you don't go beyond that, because you do not want to deal with multiple investors with multiple conditions. However, if you're setting up the fund, as I spoke about, that you can set up it as a trust, as a body corporate, or as an LLP or a company. If the fund, which is like the 5% of funds in India, AIF in India, is set up as a company, then in that scenario, the Companies Act become applicable, and which states that for a private limited company, the maximum number of members which you can have is, or a shareholder, is 200. So then you have to abide by that particular limit if you're setting up as a company. So I think that is also the restriction which is being put in when you're setting fund as a company and not as an what do you call it, as a trust. So I think there's more flexibility in the trust structure as compared to the company structure, and also there is a tax leakage at multiple levels in the company structure, which vis-a-vis the trust structure. And as I say, there's a different discussion which we can have on this particular aspect of tax structuring. And as I say that the way to solicit or collect funds from investors is primarily by way of private placement memorandum, and this is privately placed. So you cannot just you cannot just kind of give it to everybody and say, okay, this is a fund you can invest. It's a privately placed. The disclaimer is being added to it, and you have to state that it is for the purpose of A, B, or C. So I think this is something which you really need to consider into, other than the other investment conditions and restrictions, which are more like code of conduct, the general conditions which is there for the purpose of investment conditions. So as I spoke about that, AIF in the angel fund category is kind of picking up. So I just thought to kind of discuss major criteria in the AIF fund category. So what is an angel investor? So as I spoke about earlier also, an angel investor who proposes to invest in any angel fund, individual investor of a net tangible asset of 2 crores, body corporate, which is 10 crores, or any other AIF which is registered under the VCF regime, where an angel fund can invest. Now, very typical, we have been speaking about what is startup. So angel fund can invest in a startup, which can be a private limited company or LLP. What is a startup? It is an entity, the date of incorporation. From the date of incorporation is not completed 10 years. The turnover since the date of incorporation have not reached 100 crores. Or it is not promoted by an industrial group whose turnover is 300 crores. And it is not a company which has certain kind of family connection with any of the angel investors, because then there will be a conflict of interest. So this is primarily the key criteria for angel fund investors. And moving on to the next slide. 1 minute. Yeah, so key regulatory conditions for angel fund, as I've already discussed majority of these conditions. If someone wants to kind of read through this, set up as a trust, minimum requirement is 5 crores. Per investor is 25 lakhs. As I said, that if you really want to explore this particular regime of investment, this is very good because you don't have to shell out 1 crore, and this 25 lakhs is over a time of the life of the fund. And new pooling vehicles, or I would say new angel funds or angel platforms, are coming up with their own limited requirement per annum and for the life of the fund. So you have to kind of abide by that, whatever they're kind of bringing in. Maximum investor per scheme is 200 here. Minimum contribution is 50 lakhs or 2.5% of the corpus. So this again is reduced for an angel fund category. Maximum investment per investee is 25% of the investable corpus in any one investee company. Investment limit per scheme. So it should not be more than 25 lakhs and shall not exceed INR 10 crores. Lock-in in an investee company is for 1 year. Investment in associate is not at all allowed. Again, it's a closed-ended fund with a minimum tenure of 3 years, which we have discussed earlier. Co-investment condition for manager and sponsor is only allowed if the manager is set up as a PMS regulator. Then only they can invest. And the investment condition to a manager should not be favorable as compared to an AIF, because there will be a conflict of interest then. Custodian mandatory if it is above 500 crores. Foreign investment is in AIF definitely permissible, as I've discussed earlier. ODI, overseas direct investments by these AIF into entities set up outside India, are liable to do that, and they have to kind of abide by the FEMA, Foreign Exchange Management Act regulation, whatever it is. The leverage not permissible except for meeting the temporary funding requirement or day-to-day activities, as I discussed earlier for the Cat 1 and Cat 2 categories. Tax regulations, as I just spoke about, that trust is regarded as a pass-through status, and it is the taxability is directly in the hands of the beneficiary, which are the investors. So then there is no tax at the trust level. So what are the important things when you want to set up an AIF under any of these categories? You have to decide on the name, you have to decide on the scheme. So just wanted to tell you that under one AIF, you can have multiple schemes, but you have to define those schemes. So you can set up an AIF, and under that you can have sub-schemes or sub-funds, what you can call it, with different themes. Or I mean, then you have to apply, for every scheme you have to apply to SEBI. For angel fund, that's an exception. You need not apply, because for every portfolio company, there is a scheme. So they follow a slightly different structure than the other. But for category 1, other than angel fund, category 2, category 3, for each sub-scheme, you have to apply to SEBI, and they'll give you that registration for the SEBI, and you have to pay some amount for per scheme. Size and tenure, so you have to define what is the corpus of the fund, what is the tenure of the AI, if it is 10 years, 8 years, 10 plus 2, whatever it is. Propose investors, whether you want to raise funds domestically or internationally, because that will define your entire structure, as I just spoke about. If it's domestic, you need not worry about it. Just have a trust entity, investment manager, sponsor, you're sorted in life, and have those documentation in place. However, if you think that there's a lot of international investors which are pooling into the domestic AIF, then you really need to have that international tax efficient structures in place. Because if that is not in place, and if investors are kind of paying 30 to 35 or 40% of the taxes, then they would not prefer India as a regime. So you have to then either set up the funds in the gift city, or set up fund in Singapore, Mauritius, wherever you find it most tax efficient. Your international investors find it most tax efficient. Sponsor and manager of the AI, you have to figure out who want you to be the shareholder, who are the key management persons, who is the ultimate beneficiaries, what is the residential status and citizenship of the UBO, which is the ultimate beneficial ownership. Now, why this becomes important is because there may be a scenario where a manager is an entity which is incorporated in India, but it is owned by, let's say, two shareholders. One of them is owning 51% and the other is owning 49%. If the 51% holder is a non-resident Indian or a foreign individual, then in that scenario, that investment management entity will be regarded as foreign entity and not an Indian entity for the purpose of FDI regulation. So once you set up the fund, once everything is in place, what you're actually doing is making investments into India. And when you make investments into India, you have to follow FEMA regulation. And under FEMA regulation, you have to follow foreign direct investment regime because this AI structure fall under the FDI regime. So when you do that, you have to figure out whether the fund is an Indian fund or it's a national fund. If it's an Indian fund, then Indian regulations are applicable. The FEMA is not going to play any role in it. However, if it's an international fund, and in my 51% entity of a manager is owned by international investor or international or a non-resident, that manager would be regarded as a non-resident investment manager, and therefore FDI regime is applicable to it, even though
Recording in progress.
team members, investment team, the experience which is important, the hurdle rate, which is primarily the rate at which the investors would want to make an investment, the minimum amount of hurdle which they expect from the fund. It fluctuates between 8 to 10% right now. And of course, you have to speak about the IRR or multiples. Then proposed charges related to AI, which I think is very, very more operational related decision which you have to take. We spoke about the typical size, like my typical size is $2 to $5 million. If it's like a $100 million fund, and also about your reinvestment strategy, whether you reinvest into the company, then a minimum amount of the corpus needs to be pulled back so that you can reinvest in those companies. So these are the things I've actually quickly have to run through this because the time is very limited. It was just 1 hour to me. And there's a lot more which I can talk about on the
Recording in progress.
So that you can have a rough idea of how this regime works. This is all from my end. I pause here and I am happy to take any question and answers which you may have. Yeah.
Yeah, ma'am, can we take a couple of questions that are there in the inbox?
Sure.
I shall read it out just once.
Yeah, sure.
Okay, the question says that when we form an AIF, are we required to submit the number of limited partners and the amount committed by each limited partner? Are we required to submit that?
No, what you only need is a sponsor. Typically you need a sponsor. So as I say, that the skin in the game. So for SEBI, you don't have to tell that I've raised 50 crores and now I'm coming to you. No, SEBI says if you propose to raise 50 crores, come to me with somebody who is known as sponsor, who tells that I have skin in the game. So like whosoever has asked that question can also be a sponsor if it requires it to have a minimum net worth of X amount, which is being stipulated in the regulation. And then it can go and says that, okay. And as I said, the maximum limit is 1,000. And you can also say that, no, I only want 10 people. And that's what people do. So you don't have to define and tell. Of course, there may be a scenario where you have international investors and you say that I propose to raise funds from this regime, from these international investors and all. Then there may be a possibility that SEBI may ask what kind of investors are they, but still they will not tell you to name them. You don't have to name them that it is a foreign DFID or whichever entity it is. So you don't have to name while taking a SEBI registration.
All right, ma'am, there is an extension to this question. Further, it says, can the limited partner increase the committed amount towards the fund? And so, how long can the fund be open for commitments from limited partner?
Yeah. So there is a concept of first close and second close. Okay. So when I say limited partner, I'm not able to understand that person's question of limited
what you have is member. Okay. Limited liability partnership is the least used option in India because there is a gray area whether foreign investor can make investments in it or not. So we don't use that structure for the trust per se. However, coming back to the question, so I'm giving that clarity because that person is using limited liability or limited partnership. So can you repeat that question, Chandani, for me?
Yeah, sure. Can the LP increase the committed amount towards the fund? And
Yes.
how long can the fund be open for commitments from LP?
Yeah. So I will answer the second part first and then the first part secondly. So I spoke about the tenure or the life cycle of the fund, which is 10 years. Barabar hai? I say that my commitment period is 5 years, which technically means that I can invest into companies over a period of 5 years. So मैं 5 साल तक की company में invest कर सकती हूँ from the date of my final close, right? Which now, so I'm just coming to that part of the question, which implies that for 5 years I'll make investment. 5th year and onwards I will start exiting because मेरे fund का life 10 साल है. मैं exit नहीं करूंगी तो 10वें साल तक मैं थोड़े ना सारे companies मेरे हाथ में लेके बैठूंगी, right? I also need to give exit to my investors. Okay. Prior to that commitment period comes the closing, the first closing and the second close. If my corpus is, let's say 100 crore, taking that example only, I say my first close will happen at my first close will happen at 40 crore. तो जब तक मेरा 40 करोड़ नहीं रेज करूंगी ना मैं इन्वेस्टर से, तब तक मेरा फंड ओपन रहेगा. ओपन implies I need to have a minimum of 40 crore from any amount of investors. Okay, who says, जैसे चांदनी ने बोला मैं 10 करोड़ इन्वेस्ट कर रही हूँ, ठीक है, रिंकल बोले मैं 10 करोड़ कर रही हूँ, कोई और बोला मैं 5 करोड़ कर रहा हूँ. जब तक मेरा 40 नहीं होगा कि मेरा फर्स्ट क्लोज will happen from 18 days of the date of registration of the getting SEBI registration. So 18 months mein I have to take that 40 crore, I have to raise that 40 crore. Okay, there may be a possibility someone may ask yaar nahi raise ho raha hai Prachi, I am not able to raise that 40 crore. So you may go to SEBI and take that extension, but then that extension is not unlimited. At some point in time you have to pause and say bhai nahi ho raha, I am closing the fund. Okay, so 18 months is the time frame which you will be given to raise funds, and this you can decide. SEBI is not telling you to decide. SEBI has given certain timelines within which you have to decide, but you will decide that amount at 18 whatever, like 18 months mein I will do the first close. So 40 crore पे अगर मेरा first close हो गया तो मेरा fund तो 100 crore का है, लेकिन जैसे ही मेरा first close होगा मैं investments करना शुरू कर सकती हूँ. So I can start deploying money in companies. Startups में पैसा डालना शुरू कर सकती हूँ, उसके पहले नहीं. उसके बाद मैं बोलती हूँ मेरी सेकंड और फाइनल क्लोज है 100 करोड़ पे, विच इज माय फंड साइज. तो मुझे फंड साइज तो रीच करना पड़ेगा ना, तो मैं अब सेकंड में रोटेटिंग लेवल पे क्लोज करती जा रही हूँ. ठीक है, सो देयर में बी अ पॉसिबिलिटी कि मिस्टर एक्स या चांदनी ने मुझे 5 करोड़ का कमिटमेंट दिया, एंड शी रियलाइज दैट प्राची इज डूइंग इट प्रीटी वेल, शी इज एबल टू इन्वेस्ट इन गुड कंपनीज. So first close में you have given 5 crore, but when I'm announcing the second close and the second and final close, prior to that you may come and tell me that boss, I want to add another 5 crores to my already existing investment size. So you can definitely add on to that 5 plus 5 and you will be now 10 crores in the entire. So you will own 10% of the fund, which like agar मैं 100 का example है. So that is possible.
Right.
I
So,
hope
ma'am,
I'm able to answer that question for that person because I'm not able to speak to that person.
Correct. And the last question is, I suppose that has also been answered by you in this thing. Can we add more LPs to the fund subsequent to the closure?
Yeah. So if I have announced the first close, then I can definitely add. But once I have announced the final close, then there is no possibility because it's a close-ended fund. Life close हो जाती है उसकी, fund close हो जाता है. Of course, very glad वो बंदे को मैं बोलूंगी कि आप मेरे second fund में आ जाओ अगर आपको लगता है तो. But yes, you can't do it once I have done it. तो वो decision आपको पहले मेरे साथ लेना चाहिए था. मतलब that's what I will say.
Right. Perfectly answered, ma'am. That was amazing. I think we do not have any further questions, and whatever questions we had, you have very nicely answered. So with this, shall we conclude, ma'am?
Yeah, please go ahead. And I am just very happy. I'll just say because I know it's a World Cup. 397 by 4 for India, 50 overs. I think कितने लोग सुन रहे हैं मुझे वो भी नहीं पता है because it is so exciting and I think we're going to win it. New Zealand is not going to make 400, so we have killed it today and hoping that we get the World Cup back to India. And I'm in Gujarat right now. for Diwali vacations in Bhuj. So I've taken this from there, and I know my entire family sitting and watching cricket, and they were like, and of course they're enjoying because they know that we will win. So happy winning to all of us. Like, we are very proud of getting. I mean, we live cricket, right? We just eat, sleep, and live cricket as Indians.
Absolutely. Ma'am, just to conclude, so my dear friends, let me express my sincerest gratitude to Prachi ma'am. Ma'am, thank you so much. That session was really insightful. You very well took us back to the history, and then, the inclusions and exclusions of AIF. Even the categories were very well presented. The statistics that you put forth, you acquainted us with. I believe each and everything, ma'am, was unrevealed so meticulously. Ma'am, these kind of sessions are always a kind of, I would say, the hand holders or the refreshers for the members. But you have truly justified the purpose, ma'am, with which, this session had been organized. So thank you so much, ma'am, for spending your valuable time to enlighten the members. On this note, my dear friends, we shall now close this session, and we shall be meeting next Wednesday again with yet another intensifying session, of course. Till then, enjoy this festive season with your near and dear ones. Thank you and have a nice day ahead.
Thank you, Chandni. Thank you so much. And it is always delightful to be back to where you belong. I mean, CA is our alma mater. It's our fraternity. And it's always good to give it or maybe pay it forward to people and be part of it. So it's always a pleasure to be on this platform. And I love being here. I know today's Baiduj, and I actually questioned her why on Baiduj. And Jaya told me, no, ma'am, आते हैं सब लोग. Last time हमने होली पे किया था, and people turned up, and there were 400 people listening to us. And I was amazed by the commitment. So I said, no, I will be there. Then don't worry.
That is what we are really grateful to you, ma'am. Thank you. Thank you so much.
Thank you so much.
See you.
Bye.